For decades, the global financial system has been built on a seemingly rational premise that the US dollar is the safest and most liquid store of value. As a result, central banks around the world allocate a significant share of their foreign exchange reserves into dollar-denominated assets, particularly U.S. Treasury securities. By the third quarter of 2025, global reserves stood at approximately $13 trillion, with roughly 56 to 57% still held in U.S. dollars, equivalent to about $7.4 trillion anchored in a single currency. At the surface level, this allocation is entirely rational. The U.S. Treasury market remains the deepest and most liquid sovereign bond market in the world, and the dollar continues to function as the central pillar. Yet beneath this rationality lies a deeper structure. Dollar dominance does not merely provide safety, it also generates an asymmetric distribution of benefits. Despite repeated discussions about diversification, the world continues to hold U.S. government debt on an extraordinary scale. As of January 2026, foreign holdings of U.S. Treasuries stood at approximately $9.305 trillion. This is not just trust. This is a global funding mechanism. This asymmetry becomes clearer when examined alongside the fiscal position of the United States. In nominal terms, the U.S. economy reached $31.4 trillion in 2025. Yet in that same year, federal spending totaled around $7.01 trillion, while revenues reached only about $5.23 trillion, resulting in a deficit of roughly $1.78 trillion. By March 2026, total federal debt had risen to approximately $39 trillion. At the same time, interest payments reached around $970 billion, slightly exceeding defense spending. The fact that a country with such fiscal magnitude can continue to borrow at relatively low cost suggests something deeper. The dollar's advantage is not merely monetary. It is institutional and geopolitical. U.S. 10-year Treasury yields hovered around 4.2%. Meanwhile, Indonesian bonds traded around 6.8 to 7.0%. Despite Indonesia having lower debt ratios, borrowing costs are not just about fundamentals. They are about hierarchy. Indonesia provides a useful illustration. As of February 2026, foreign exchange reserves stood at approximately $151.9 billion. For Indonesia, reserves are protection. For the United States, they are funding. Indonesia runs a goods trade surplus with the United States, estimated at $20 to $25 billion. On the surface, this appears favorable. But this interpretation is incomplete, because the real question is not who exports more goods, but who owns productive assets and who receives the income. U.S. investors maintain strong positions in Indonesia, mining, energy, capital markets. These assets generate flows of income that move outward. Indonesia records a large primary income deficit, exceeding $40 billion annually. Even a conservative estimate suggests around $20 billion may flow to U.S.-linked entities. Indonesia invests in safe assets, earning modest returns. Meanwhile, foreign investors extract higher returns from productive assets in Indonesia. This is the asymmetry. Indonesia exports raw materials, low wages, low value-added goods. The United States controls technology, finance, branding. At the global level, this system repeats. The world sends capital to the U.S. The U.S. spends it. In 2025, U.S. imports reached approximately $4.33 trillion. Public debt becomes private income. Lockheed Martin recorded $75 billion in revenue, with 72% coming from government contracts. This funding supports employment, over 1.3 million active duty personnel, and millions more in supply chains. The United States has a negative net international investment position, around minus $27.6 trillion. Yet it earns more income than it pays, because the world holds low-yield safe assets. While the United States holds higher-yield global assets, the dollar is no longer just a currency. It is a structure. The world provides capital. The United States captures value, and the system continues, not because it is imposed, but because it is chosen. The question is not whether this system exists. The question is when and how it will change.